Don't buy the hype that you can't get that good of a deal. This thing's been on market for 90 days now in this condition. There is nothing wrong with asking for the number that makes sense for you. It's a carcass property. It's just kind of rotting here. The city is watching this and they're requiring full permits to get this project up to new standards. That means it's gonna take 12 to 15 weeks just to get started on this project. I've even been hearing investors talk about how the BRRRR strategy is dead right now, which is not, but you need to make some adjustments. Hey BiggerPockets, it is James Daynard, and today we are talking about BRRRRing your next property in 2023, and is BRRRR actually dead? I don't think so. So we're actually touring a property up in Everett, Washington. I'm walking through it, I'm running my metrics and seeing if this will actually work as a BRRRR. So before we do our walkthrough, let's talk about what a BRRRR actually is. It's when you buy, you renovate, you refinance, and then you repeat and go do it again. So the purpose of the BRRRR strategy is to buy below market value, do the renovations, and be all in at 75% of the new appraised value. So why is 75% kind of that magic number? Is because most banks will lend you up to 75% of new appraised value, and if you can keep your purchase price and rehab inside that number, it gets you most of your capital back, and hence the repeat, to where you can buy it, increase the value, get your rental property, and then go get another one because your money's not locked in. It's a great way to create value in your portfolio, grow exponentially, and continue to keep buying. So let's walk through this property. Let's talk about the pros and cons of BRRRRing with the higher interest rates, and let's see if this property actually works. So before you go buy that next BRRRR property or look at buying that next BRRRR property, make sure that you have the right team around you. Your team is going to be essential to whether you can execute that right plan. The first person you need is a real estate broker that understands what you're doing. You want to make sure that they can run the analytics for you on what the as-is value is and what the improved value is. If you don't know how to put you on the right metrics for this property, it can throw you way off on your down payment and whether you can actually get all your capital back. The next thing you need is a bench of lenders, because in BRRRR properties, many times they're in condition like this, right? Where it's down to studs, there's electrical hanging down, we actually got a red tag on the door. That's not going to be for a traditional lender. We're going to go get a construction loan on this property. We're going to set it up with hard money. They're going to finance in the repairs, and we're going to have to come up with about 15 to 20% down and then get the property stabilized at that point. The second group of lenders you need is either a local bank or a mortgage broker or a regular bank. The reason you need that lender is because when you take the property down with hard money, you're paying 10 to 12% interest, which is really expensive. You can't stay in that money. It's made for a short-term purchase. But once it's stabilized, you need to be able to get that cheaper rate. That's going to allow you to cash flow the property and start building wealth. And lastly, you need a good quality construction partner. Remember, on the BRRRR properties, it's essential that you want to be 75% of the new appraised value, which includes your fix-up costs. If you don't know how to handle those costs, they could go over, and then that's going to be cash you have to either leave in the deal, and it can change the whole metrics behind whether it's a good buy or not. So the BRRRR strategy can change your whole trajectory on your portfolio. You're buying properties below market, you're picking up massive equity positions, and you get to leave your capital in your bank account to go buy that next deal. I know personally, I used the BRRRR strategy through 2006 to 2009. We acquired like 8 to 9 rental properties this way, and we ended up trading those 9 properties for almost $400. It changed our whole trajectory as real estate investors. But in 2023, if you don't pivot your plan, it can be a very risky strategy. I've even been hearing investors talk about how the BRRRR strategy is dead right now, which is not, but you need to make some adjustments. So why is it risky? It's risky because the rates are changing on a monthly and weekly basis. Every time the Fed chair comes out, he says he's going to continue to increase rates. If you're trying to factor in the debt on today's pricing, it could be different down the road. That means your payment will be higher. In addition to, it can have negative impacts on the market, and your value could come down by the time you're done renovating the property. So the bad news is BRRRR has got more risky. You have more risk in your interest rate, Construction costs are kind of all over at this point, and you have to really pad your performance and really forecast out those rates. But the good news is investors are starting to slow down. We are seeing way better opportunities. I actually haven't really been buying BRRRR properties the last 24 months, but now I'm heavily looking. I like looking when no one else wants to do these things. Everyone's looking at rental properties and they're seeing the 7 and 8% rates and they can't figure out how to make it pencil, which I am all over. These big fixers, we were having to pay 65 to 70 cents on the dollars just to get in the door for the last 24 months. Now we're seeing them trade at historical levels. Typically, we're buying these things at 50 to 55 cents on the dollar. I don't really care if my interest rate's higher because I can offset that with my rents and just to buy cheaper. If there's low demand and the projects need a lot of work, that means that I'm the buyer a lot of times in a lot of neighborhoods. That means I can pay whatever pricing that I want, and it really allows me to dictate those numbers. So how are we pivoting based on the riskier market and the opportunities that are available? So things that we're doing to mitigate risk in buying our next BRRRR. The first thing we're doing is when we're performing deals, we're adding contingencies and we're padding our pro forma. You hear me talk about that a lot in this pivot series because that's how you mitigate risk. We are taking comps. If today's value is at 900,000, we are taking about 5% off the value. Or we're going with the medium comps and not going for the high comp. By doing this, if the market continues to slide backwards and the appraisal comes in a little bit lower, we're covered at that point. It gives us a 5% buffer. That means our money is not going to get trapped in the deal. In addition to, as we're performing out our rents and our cash flow, we're adding about a half point to whatever the rates are at currently today. The Fed Reserve keeps announcing that they're going to increase rates, so I need to build that into my pro forma. It doesn't really matter if the rates are 7, 8, 9, 10%. I really don't care. I just have to account for it in my pro forma. So pad in a little bit more. If you think that rates are going to go even higher, then add an extra point in. If you think that rates are going to go lower, knock 3/4 of a point off. You just depends on what your kind of appetite for risk is. In addition to, we are adding 5 and 10% to all of our rehab plans. The reason being is we don't know what's going to happen with inflation and what's going to go on with the supply chain issues and other energy issues. If we come in 10 to 20% over budget when we go finish out the project, that's just money I got to leave in the deal. That's good capital that I can go acquire more properties for. So I pad in the rehab expense to make sure that I'm fitting all inside that 75%. As long as you pad all those things, it will work out. Another thing we're doing is we're being conservative on rents. We don't want to use that top end comp. We want to use more of the median comps. The reason being is we've seen a lot of growth, 20 to 30%, a lot of different markets, and some of that data could be bad, just like your high comps from the spring. So if you're looking at buying your BRRRR property, you want to make sure you're covering your mortgage payment. You want to make sure you're not going with too high of a comp, because if it doesn't quite rent out for that price, you're going to be stuck paying that bill, and that just turns into a liability rather than an asset. So another thing that we're doing on our next potential BRRRR investment is we're asking for longer closing times. The risk in BRRRRs is when you buy that property, you're buying it on a good deal today. If the market slides backwards or rates go up, it could turn into a bad deal down the road. The time of the renovation is actually your risk in the market. The quicker you get your project done, the less risk you actually have on that deal. So if we're looking at this project right here, what we do know is it's been red tagged. The city has came in and stopped the work on this project. It's actually an investor bailout deal, or what my good buddy Gabe Rosenshine says is it's a carcass property. It's just kind of rotting here. The city is watching this, and they're requiring full permits to get this project up to new standard. That means it's going to take 12 to 15 weeks just to get started on this project. Imagine if we're going into a volatile market with 12 to 15 weeks before we can even start. So a lot of times on these problem projects or projects that take longer permits for my next BRRRR, I'm going to ask for a delayed close or a close on permit. This reduces my risk exposure in the market, and it allows me to make sure that my numbers are still solid. All right, so now that we talked about how to mitigate risk and how to pivot with your BRRRR strategy going forward, let's look at this deal that we're at right now and whether I would buy this as a BRRRR or not. So it's listed for $499,000 right now. It's worth about $800,000 to $850,000 after all repairs, and it needs about 125 to 150. If I look at leaving about 10% in this deal, or about $60,000, which puts me at about a 75% loan to value, it's gonna put my mortgage payment around $3,800 before property taxes and insurance. My rents here are $3,800 to $4,100 a month. So no matter what, I'm gonna be losing money on this property. The upside on it is I'm gonna be picking up about $150,000 to $160,000 in equity position. So I'm putting out $60,000 and I'm getting this big equity position at the end of the day. But I'm still gonna be losing money for the next 1 to 2 years. Every time I'm looking at a BRRRR property, I'm looking at today's number. I am trying to break even on that payment so I don't have a liability and have to service this house for a long period of time. But I'm also then looking at where's the long-term gain in this property. I don't want to get trapped on, hey, rates are so high, I'm buying this property, it's not a good deal because it's at 7.5%. The rates are going to be this high for a shorter term period. I think that after 2 years, that rates are gonna be in that high to mid fives at that point. We're gonna get through our recession, we're gonna get the inflation under control, and then the rates are gonna come back down. When I look at this deal at a 5.5% rate, it dramatically gets better. My payment is roughly about $3,400 a month, including taxes and insurance, and I'm gonna get around $4,000 a month in rent. That's $600 a month in cash flow for leaving 60 grand in the deal. That's a 10% return. That's a buy all day long for me. But I am not willing to pay this price right now. The reason being is this is a huge project. If this was a cosmetic fixer and I could leave 10% of the deal and have a 10% kicker down the road, I will look at that property. But on big fixers, again, it's bigger risk, it's more work. I don't want to work on a property for 6 months just to make no money and have to pay for it. So what I am doing is I'm writing an offer based on my break-even number. I ran the math backwards. I know this property is listed at $499,000. I need to be at $410,000 plus the renovation to get me inside that loan to value to where I'm getting the $60,000 back and I'm not leaving it in the property. And then my mortgage payment's gonna be around $3,200 a month plus taxes and insurance, so I'm breaking even every month. Don't buy the hype that you can't get that good of a deal. This thing's been on market for 90 days now in this condition. There is nothing wrong with asking for the number that makes sense for you. So as a BRRRR investor, I want to narrow my buy box. I want to know what I will buy and what my requirements are. So in 2023, I'm trying to leave less than 10% of the deal in each one of the properties. I'm looking for development upside. I want to buy a single family house that I can sell 2 or 3x down the road for more because there's more value there. In addition to, I want to make sure that the asset is breaking even or slightly paying for itself. I am actually not too concerned about the cash flow because I think I'm going to make up for it when the rates fall later. But I don't want to have 5 and 10 more additional properties that I have to feed every month and wait that rate out. So as long as you know your buy box, work your numbers backwards, stick with your offers that work inside what you're trying to accomplish, and you can get that BRRRR property. So yes, BRRRR properties are going to be more risky in 2023 if you don't make the right adjustments. But I know personally in 2008, when no one wanted to buy BRRRRs or rental properties, we cleaned up. We identified what our buy box was. We knew what we were going to buy, and we would work the numbers backwards and secure the properties for those numbers. This property here right now does not work for me on its current list price, but there is always a number that I will buy it at. I know that I need to be about $80,000 cheaper on this property if I'm going to pull the trigger. By knowing this, it either identifies that I'm going to move forward with this property and start working the offer, or just move on to the next deal. Work the numbers backwards, find out what your goals are, and you can still BRRRR in 2023. So if you enjoyed this video about BRRRRing in 2023, make sure you like and subscribe below, or for more strategy advice or just free information in general, check us out on jamesdaner.com or my Instagram at jdaneflips, and we will see you guys next time.